Do banks look at cash deposits? Banks report cash deposits over $10,000. IRS shares suspicious activity. Banks closely monitor cash deposits, particularly those exceeding $10,000. This monitoring is not just a matter of routine procedure. It is a legal requirement under the Bank Secrecy Act, BSA. This federal law mandates that financial institutions report any cash transactions exceeding $10,000 to the Internal Revenue Service, IRS. This reporting aims to track and prevent money laundering, tax evasion, and other illicit financial activities. The scrutiny isn't limited to the IRS alone. Local and state authorities also receive information about suspicious deposit or withdrawal activities. This collaboration between banks and law enforcement helps maintain the integrity of the financial system and ensures compliance with anti-money laundering (AML) regulations. The $10,000 threshold is not arbitrary. It's a key trigger for heightened scrutiny. Deposits below this amount generally attract less attention, but it's essential to note that multiple smaller transactions that cumulatively reach or exceed $10,000 can still trigger reporting requirements. This practice, known as structuring or smurfing, involves intentionally keeping individual transactions below the reporting threshold to avoid detection. However, banks are vigilant in identifying and reporting such patterns. Businesses also fall under the umbrella of these regulations. When a business receives substantial amounts of cash, especially for significant purchases like cars or real estate, banks are obligated to report these transactions. This broader scope ensures that the reporting requirements cover various financial activities, reducing the risk of individuals or entities evading detection by exploiting loopholes. In simple terms, when it comes to cash deposits, banks not only look at them but are legally mandated to scrutinize transactions, particularly those surpassing $10,000. This scrutiny is a vital component of the broader efforts to combat financial crimes and maintain the integrity of the financial system. What is the risk of depositing cash in a bank? Depositing cash in a bank carries inherent risks, primarily related to liquidity. Liquidity risk arises from the bank's reliance on deposits, which can be categorized into two types: time deposits and demand deposits. Time deposits have specified maturity dates, meaning the funds are committed for a predetermined period. While this provides the bank with a more predictable cash flow, it also poses a risk if a significant number of depositors decide to withdraw their funds simultaneously, especially before the maturity date. This scenario can strain the bank's liquidity and ability to meet withdrawal demands. On the other hand, demand deposits, also known as non-maturity deposits, do not have a defined maturity date. Account holders can withdraw funds on demand. While this provides flexibility for depositors, it poses challenges for banks in managing their liquidity. Sudden, large-scale withdrawals can create liquidity shortages, potentially leading to financial instability. Additionally, banks face interest rate risk related to the maturity of their assets and liabilities. If a bank's assets, like loans, have longer maturities than its liabilities, such as deposits, changes in interest rates can impact profitability. For example, if interest rates rise, the bank may have to pay higher rates on deposits while earning lower rates on existing loans. Credit risk is another concern. Banks use deposited funds to extend loans, and the creditworthiness of borrowers can affect the bank's overall risk exposure. Economic downturns or unforeseen events that impact borrowers' ability to repay loans can lead to increased credit risk for the bank. Operational risk is also present, encompassing factors like technology failures, fraud, and inadequate internal processes. A bank's ability to manage these risks effectively is crucial for its stability and sound operation. While regulatory measures are in place to mitigate these risks, depositors should be aware that the safety of their deposits relies on the financial health and risk management practices of the bank. Choosing reputable institutions with a strong financial standing and adherence to regulatory guidelines can help minimize the risks associated with depositing cash. What amount of money triggers a suspicious activity report? Banks are required to file suspicious activity reports, SARs, under various circumstances, with different dollar amount thresholds triggering these reports. These thresholds are established to detect and prevent potentially illicit financial activities, including money laundering and fraud. Number 1. Insider abuse. SARs must be filed for insider abuse involving any amount. This includes suspicious activities conducted by individuals within the financial institution who misuse their position for personal gain or to facilitate illegal transactions. Number 2. Identifiable suspect. Transactions aggregating $5,000 or more that involve an identifiable suspect trigger a SAR. This threshold is in place to capture activities where there is reasonable suspicion of illegal conduct. Number 3. Large transactions. SAR filing is mandatory for transactions aggregating $25,000 or more, regardless of whether there is an identifiable suspect. This threshold aims to capture significant financial movements that may indicate potential illicit activity. Number 4. General threshold. Transactions aggregating $5,000 or more also trigger a SAR, even without an identifiable suspect, emphasizing the importance of monitoring a broad range of financial activities. The purpose of these thresholds is to create a comprehensive framework for identifying and reporting suspicious activities. The focus goes beyond specific dollar amounts to include the nature of the transaction, the individuals involved, and any patterns indicative of potential wrongdoing. It's crucial to understand that these reporting requirements are not designed to impede legitimate financial transactions but rather to ensure the integrity of the financial system. Financial institutions play a critical role in maintaining transparency and preventing the misuse of the banking system for unlawful activities. By adhering to these reporting thresholds, banks contribute to a collective effort to combat financial crimes, protect the financial system, and enhance overall security. The information provided in SARs serves as a valuable resource for law enforcement agencies in investigating and prosecuting individuals involved in illicit financial activities. In short, SAR filing thresholds are structured to capture a range of suspicious activities, from insider abuse to large transactions, reinforcing the commitment of financial institutions to maintaining the integrity of the financial system. Is depositing cash at ATM safe? Depositing cash at an ATM can be safe if certain precautions are taken. While ATMs offer convenience for cash deposits and withdrawals, it's essential to be mindful of potential risks and adopt secure practices. Number 1. Choose well-lit ATMs. Select ATMs located in well-lit and populated areas. This reduces the risk of unauthorized individuals lurking around and enhances the overall safety of the transaction. Number 2. Protect your PIN. When making a cash deposit, ensure that you shield your PIN from prying eyes. This precautionary measure prevents unauthorized individuals from gaining access to your account. Number 3. Use ATMs with security features. Opt for ATMs equipped with security features, such as surveillance cameras. These features act as deterrents to potential criminal activity and provide additional security for users. Number 4. Be aware of surroundings. Stay vigilant while using the ATM. Be aware of your surroundings and avoid distractions. This awareness reduces the likelihood of falling victim to theft or other criminal activities. Number 5. Verify transaction completion. After making a cash deposit, confirm that the transaction is completed and the funds are reflected in your account. This ensures that there are no discrepancies or issues with the deposit. While these precautions can enhance the safety of cash deposits at ATMs, it's important to note that no system is entirely risk-free. Users should also monitor their accounts regularly for any unauthorized transactions and report any discrepancies to their bank promptly. In conclusion, depositing cash at an ATM can be safe by following security best practices. Choosing secure locations, protecting your PIN, and staying vigilant during transactions contribute to a secure and efficient cash deposit experience.